Hi there, and welcome all to this Evening Standard US general election broadcast. It's in association with IG, which many of you will know. It is a world-leading online trading and investments provider, and we are delighted to have them. I'm joined today by Chris Beauchamp, who is the Chief Market Analyst at IG. He's in London, and also by Chris Vecchio, who is the currency strategist for the daily FX, an arm of IG. He is in New York. I'm Simon English. I am the senior city correspondent at the Evening Standard. Gents, it's been quite an exciting few days. I'd first like to ask Chris in New York, if I could. That city's been through an awful lot lately. I just wondered how it was to be there on the night of the election. Just give me a flavor of how it felt.
It was certainly tense, New York being a blue city, as it were. A lot of concern was about how the presidential election results would shake out. But seeing as how the votes are still being counted, not just in New York, but nationwide, New York, in fact, is not even going to open up their absentee ballots until next week or the week after for the count. Right now, this is really just a wait and see mode, but the tension is certainly there. It feels like that after 2016, when we saw all the models tell us, Donald Trump only has a 1 in 10 chance of winning, those are still similarly the odds that we have now today, about 1 in 9. However, the results have come out now, and we've started to see the way things have shaken out in the Midwest, alongside the West Coast and the Southwest, and it does appear that Joe Biden is on track to get the 270 electoral votes that he needs. And to that end, it doesn't seem like people in blue cities, so to speak, will be taking to the streets to protest or riot like they had been all summer long.
It was interesting watching it from here in terms of how American markets were moving. So in the day before, or as voting was starting, you had this huge surge in the Dow, this bet on this supposed blue wave trade, as it was called, this assumption that Biden would sweep it. And I think the thinking was that would then lead to lots of government spending. So you had shares going up and the dollar going down. And then I think, if I'm remembering right, when the Florida vote came in, there was suddenly a lot of panicky people. Where it felt like that from here. Is that what you observed?
That's definitely my point of view. And I actually didn't quite understand the market reaction around Florida because I never thought that Florida had a chance to go to Biden. The fact of the matter is, over the last few years, Republicans have added 300,000 registered voters to Florida since the 2016 election. And coming into Sunday, Democrats had 650,000 absentee ballots that just were never received by the Board of Elections. People got them, they didn't vote. And so given those numbers, it just felt like it was an uphill climb for Florida. That was more of a reach state. But the idea there, what you're talking about, the dollar going down, stocks going up, it's predicated on this belief that we're going to get more fiscal stimulus. In an environment defined by more fiscal stimulus with the Fed keeping rates as low as they are, you're going to push down real yields. When you push down real yields, you need to find a place where you can meet your required returns. You're going to have to invest in riskier things like stocks, like real estate. You're going to sell the dollar. Actually, with Biden winning and looking like more fiscal stimulus is coming, gold is doing well today too as real yields fall.
Yeah, and we'll come back to gold later if we could. I wanted to ask you about oil, both Chris's actually. I wonder whether there's a feeling that big oil might be over as an investment. Trump was regarded as good for that sector. Biden less so, much less so, in fact. I just wondered, Chris Beauchamp, whether you've got thoughts on that and whether you've seen market moves in that area lately.
Yeah, I think it's very interesting times for oil, and when we say interesting, I suppose it means dire, because you know how the changing outlook for oil is really affecting how investors should regard this commodity. It's such a central part of everyone's portfolio for so many years, and of course, especially if you look at for UK investors, you've got BP and Shell, those FTSE stalwarts and huge dividend-paying stalwarts. Suddenly, the ground beneath them has shifted to an incredible extent, and the question really is, do we look at it with the same degree of certainty that we used to? I think it's very much a changed environment. That yes, Trump was always going to be a keen president for pushing for more oil, but I suppose in many ways Biden actually could be the oil industry's surprise guardian angel for the time being, because you won't have this push for more fracking, for more US production, and that at least provides one small crumb of comfort for, I think, oil investors, and that it greatly reduces the chance of hugely increased oil production in the US that will then bear down on the price. So I think in some ways, perhaps Biden is what investors in oil should be hoping for. I think longer term, of course, you have a world where oil is becoming less and less important. It seems to have been brought forward a few years, but certainly I think it's now going to be much, much harder to look at it in quite the same secure way as people used to. And I think, yes, you could still take plenty of view that the big oil majors are the ones that will survive because of their scope, their size, and their simple financial firepower, and the way that, of course, BP and others have moved to becoming more green. But they will be, I think, less and less important as time goes on. And I think that's a reflection of what we're seeing in markets at the moment. The energy sector is becoming less important in terms of its weighting in the S&P, in terms of how it will go in the FTSE 100 as well. And I think that's an interesting trend to watch over certainly the next 5 to 10 years.
I hadn't thought of that because Biden is not going to be into fracking, that you're right, they could actually boost oil for a bit, or perhaps give them some breathing space while they figure out their greenery. Chris Vecchio in New York, have you got any views on which other sectors you think might do well under Biden, or any which you think might struggle?
I actually think that technology, regardless of who is president, is going to do well. Even though we're getting through the pandemic right now, there have been certain permanent shifts in consumer behavior. The number one thing that sticks out to me, back in 2008, 7% of all retail transactions in America were done online. Coming into this year, we were at 19%. And as of June 2020, we were about 30%. So the gains that were made in just the first 6 months of 2020 in terms of how consumers are buying things in America effectively was the last 12 years of changing behavior. Those kind of shifts are permanent. So tech should continue to do well. I do think that when we have a Biden administration, while there could be some concern over higher corporate taxes, now that you have Mitch McConnell and the Republicans retaining control of the Senate, any significant leftward lurch in tax policy is unlikely. And so to that end, if we are going to see any significant shift that the Biden administration can do, it's likely going to be on the trade front. While some particular aspects of the U.S.-China trade war are likely to be maintained, I do think that a normalization of relations with places like Korea or the European Union, for example, will likely help those companies that rely on exports abroad with those reduced tariffs coming in. So right now, more of a profile towards those companies that earn revenues from abroad rather than domestically.
Let's stick with that EU thought, if we could, Chris. It's a worry over here is that Biden will do what Obama said he would do, which is to leave us Brits at the back of the queue for any trade deal he might do, that he'll just go with the EU, and if we're left out of that, then that's just too bad. Are we right to be worried about that, do you think?
I do think that's a legitimate concern. Biden is an institutionalist. He, unlike Trump, does not want to tear down the system. He wants to strengthen it, if you will. He's an establishmentarian. So to that point, he likes operating within these institutions, these global institutions that have been set up to help facilitate and encourage the dissemination of the American ideals. And so the European Union, in a sense, is one of those bodies. We want the multinational structures like the UN, like NATO, to succeed. And therefore, for the sake of sticking to the principle, I do think that the Biden administration is going to keep the UK at the back of the queue in the WTO framework.
Sure. Chris Beauchamp in London, perhaps you could pick up on that and just tell me to how you think that issue might impact on markets. So Tuesday and Wednesday this week were very turbulent. Today's calmer. I just wonder how you think things might play out, perhaps now running up through to Christmas. Are we going to get these things where you see every day these wild movements, or will it be calmer? And I just wonder how investors should think about that issue.
Yeah, I think it's interesting the way the market has been so calm over the lack of result, and B, that we do obviously have legal challenges, and C, really, that obviously we now have the split government in the US again. And I think the enthusiastic reaction, I think, is the only way to describe the way the market has rallied. I don't think the volatility will continue into the rest of the year in quite the same way, although we do live, as I've been saying to people all year, this is still very much a more volatile year than it was last year. We had the VIX spiking to 40 last week, whereas through 2019 we were quite happy to see it occasionally pop up to sort of 25, 26 and then drop back down again. So this is a year of far more volatility. But it is, I think, an environment where things will probably start to calm down from here famous last words. But given the way that Biden appears to be sort of heading towards the 270 mark and potentially beyond, makes it much harder for Trump to challenge it. And I think that is the outcome that markets are probably underpricing, is that you don't get a huge bout of volatility, about concerns about the US government. In fact, things carry on remarkably as they are.
Yeah.
And you may not get quite as big a stimulus program as you expected, but you get something that's enough to keep the market moving higher and to provide the sort of foundation for the continued recovery in the US that everyone needs. And that's why I think you've got, obviously heading into the end of the year is usually a good time for stocks anyway. The seasonal tailwinds come into play. I still think that you've still got the options for stronger gains into the end of the year. And yes, you'll have bumps in the road, but overall, I think it's a much more sunnier outlook now the election's out of the way, for markets more generally.
Well, let's hope you're right about that. Let's get back to the currency issue, if we could, staying with you, Chris, in London. If we're going to get more government stimulus, there was another big bond buying program laid out by the Bank of England today. It just feels to me that can't be good for the pound in the short run or even the longer term. What do you think?
Well, I think it's the way that the market chooses to take it, really. I think they'd rather see an activist Bank of England moving strongly to try and support the economy, one that is happy to just to let things ride as they are. And I think that's why, again, today that you've had on the signs of it, quite positive reaction to the QE news. Maybe it was also the lack of any move to negative interest rates yet, but that's another thing that may come into play. But I certainly think there are still the expectation in markets is that governments will have to do more. And in that sense, I suppose you've moved from an environment where central banks don't do anything last year to back to a very activist position. And thus that's your bar. And that's your sort of base case, is that central banks do something, and it's a question of how much they do. But if it continues to bolster the economy, then that I think will offset any of the currency weakening effects that you tend to get through QE, through cuts in interest rates. Although it will be interesting to see whether the Bank of England does go towards those negative rates and how that begins to put maybe a bit of a weakness on sterling. So it hasn't done much for the euro. It hasn't held back the euro really, which is happy to sit near 119 despite the ECB's ongoing commitment to negative rates.
Sure. And on the negative rates issue, my feeling is that the Bank of England has had such pushback from the big banks on the idea of negative rates. I mean, they just hate the idea, it seems to me. I wonder, Chris Vecchio in New York, what the feeling is in the States about the use of negative rates. To me, it feels like such a defensive thing. I can't imagine the Fed going that far, but I could be wrong. What do you think?
I do, and quite frankly, I think negative interest rates are symptomatic of a broken policy feedback mechanism, right? Fiscal policy is your engine, monetary policy is your fuel. If you have a broken engine, it doesn't matter how much fuel you put into it, it's not going to run. And negative interest rates are a symptom of when fiscal policy is not either geared properly, where the money is going into the wrong places, or simply it's constrictive, excuse me. And so when you think about constrictive fiscal policy in this environment, we're talking about austerity. I think about austerity in the Obama era and what that led to in 2010 after the Republicans took back the House, Democrats had the Senate and the White House. We're going into a similar composition right now after just a very large run-up in the U.S. debt and deficit. I have a very strong feeling that some of these Republicans who are just signing on to the expansionary fiscal policy under President Trump now will remember that they're fiscal hawks. And all of a sudden, the path towards a significant fiscal stimulus package, those are going to be a little bit more difficult. And so along those lines, where do we go from here? I do think we get one bill out of this current Congress if it's a Republican Senate and Democratic House. But I do think that we're going to see a lot about the U.S. debt limit and the U.S. credit rating very soon.
Sure. Let's stay with that debt issue. I think that's really interesting. People are always asking me, at what point do we hit, an actual ceiling, not just a political ceiling? At what point do we reach the point where we can't borrow anymore, or markets are so freaked out about the apparent size of the debt that other fiscal stimulus, quantitative easing suddenly becomes a problem? Now, I think we're miles away from that becoming a genuine concern. On the other hand, the numbers are a bit scary, Chris in New York. Do you worry about it?
It depends, right? It's really about the composition of who holds the debt. Japan, for example, has debt to GDP ratios well north of 200%, but most of their government debt are held by local domestic investors, mom and pop investors. Why would they want to see the Japanese government default on its obligations when they're the ones who would suffer? For emerging market countries, however, if they have high external debt to GDP ratios, they run large current account deficits, they have not quite developed or as stable legal institutions, that's when you could really see the high debt to GDP ratios raise some concern for investors. But the United States is in a unique position, right? It is the world's reserve currency. It's the world's largest economy for the time being. And to this end, investors tend to give it a little bit more slack. But we're now getting to a point where rock meets hard place. We're adding trillions of dollars to the debt burden this year. We've eroded our tax base. Our consumers are hurting, and our small businesses are closing. It seems like this is a conversation that we've been avoiding. We've been kicking the can down the road. It seems like we're due to pay the bill some point soon.
Chris Beauchamp in London. Are we Brits? Are we kicking the can down the road too? Is there a day of reckoning, or is it not something that's on your? It's not something that keeps you up at night at the moment.
No, not at all. I think I'm in your camp, Simon. That it's just a long way away, and I think we have to look at this in a way that says this is the closest analogy we have to the situation that the government finds itself in is wartime, and we just have to borrow until the crisis has passed. And until that happens, you can't simply say, well, we can't do any more borrowing to support the economy because we've reached a limit. If you say, for example, like the Chancellor today having to extend furlough until March, there was no way they were going to do that before. But the necessity of the situation has meant that it becomes required. And faced with the alternative, then you have to keep borrowing money. And that perhaps, to borrow a phrase from politics and markets, there is no alternative, because we need to keep the economy in some kind of form of one or another until there is a vaccine, until there's effective treatment, so we can go back to something that resembles normality. And then we have to say, well, yes, we've run up a huge bill, but we'll have to work our way of paying for it. If you look at let's look at the First World War, the UK finished paying for the First World War in about 2013. The same thing could well apply here. Yes, it's a massive burden, but with interest rates at such lows, you just have to keep borrowing. And at the moment, at least, it's still relatively affordable.
If I may jump in there, that's so important. We need counter-cyclical fiscal policy, right? We've seen a gigantic drawdown in aggregate demand here. We need governments to step up and fill the gap. This isn't a loss of some private sector access like people on Wall Street gambling on mortgages. This is a mutually borne up burden by everyone in society. And so Europe and the UK is actually doing this a lot better than the US. They're basically putting the economy in a deep freeze and saying, we'll wake it up, we'll get it out of cryogenesis once the virus goes away. The United States is not doing that, and that's a problem for us here.
Let's stick with the debt for a minute, and the fact that it's relatively affordable is partly a function of rates being, so incredibly low. If you're an investor looking for yield, there's plainly no point in buying treasury bonds. What might you think of, Chris, in New York? Where would you go if you were seeking yield?
High-rated corporate debt. AA, AAA corporate debt. The Fed is effectively backstopping it right now. And that actually creates a problem for treasuries, because if you're an investor and you can invest in, say, something that is effectively with a risk-free rate now because the Fed's backstopping corporate bonds, then why would you leave that yield on the table? I do think this creates a mechanism where there's a trade-off. Investors will start getting out of treasuries. They're going to be reaching for corporate debt. This is going to benefit those large corporations more because it keeps their borrowing costs lower than everyone else. So large mega caps, they will probably be the beneficiary of this kind of environment more so than the Russell 2000 type companies.
Sure. Just can we go back to? I'm just curious to know how New York looks. I lived there years ago, and I still think of it very, very fondly. The city of London, when I've been in to visit it lately, I've been going in once a week. It's deserted. It really is. It doesn't look like the same place. It's incredible. I just wonder what it's like downtown around Wall Street. Whether when you've been there, is it bustling or deserted?
Oh, it's deserted. I actually live right downtown near Wall Street, about 4 blocks away now. And part of the reason I wanted to live down there was because at night it was so quiet. On weekends, no one's there. But it is a ghost town now. CBRE, the commercial real estate office site manager, releases the number of turnstile swipes in the buildings in Manhattan each week, and it's still down 80% year over year.
Sure. I just wonder what impact that kind of thing has on, investor confidence. If you're sitting there saving money and thinking that you want to invest it. If when you go outside, there's nobody there, that can't be good for how you feel about those things.
Well, it depends where you're investing, right? In this kind of environment, I think Tesla, although it's going up for many other reasons, I think Tesla's a really interesting speculative vehicle. We're moving towards an environment where electrified cars are becoming more and more in vogue. And in fact, it's getting to the point where it could be cheaper for you to buy an electric car, given the maintenance and spend you would have on petrol, gas, otherwise. And to that point, if we're going to have a pandemic in place, people aren't going to be using mass transit. People are going to want their own vehicles. And if we have a future where we're going to be seeing more personal transportation on the road during the pandemic, we're going to see more green technology. That means investors could be looking at things like infrastructure investments, which offer typically higher returns because they're tied to municipal debt. You'll be looking at things like these green technology stocks, like solar. We talked about fracking earlier. Joe Biden can't get rid of fracking. He's president of the United States. That has to be done through an order of Congress. So we're going to see this interesting shift on the federal level where perhaps subsidies for the legacy fossil fuel companies, those are wind down, and instead we see efforts to boost technology, innovation, research, development for infrastructure, for green infrastructure in particular. So that's an area I would be looking for in the Biden administration right now. Even if cities are dwindling, people still need to work. Perhaps this means we have high-speed rail development in the United States finally, so you don't need to live in Manhattan in order to work in Manhattan.
Sure. All right, gents, it's neck on the block time now. I'm going to ask you both for some predictions. Let's be optimistic, and let's imagine that there's a vaccine sometime after Christmas, and let's say that come spring, early summer, the people who need to be vaccinated have been. What happens then? Let's assume there's a pretty picture for how the virus goes or is done away with. How will things look in a year's time, do you think, in terms of the stock market and the economy in the UK? First, please, Chris Beauchamp, I wonder what you think about that.
Well, I think the vaccine does wonders to restore confidence, and I think it will be overall a positive development. It's the thing everyone's looking forward to. And yes, it'd be maybe a case of you buy the rumor, sell the fact in terms of volatility when the vaccine does arrive, and there'll be concerns then about, if we go back to normal, what does that mean for central bank stimulus? What does that mean for low interest rates? How quickly will all this be unwound? But it is the necessary tonic, and I think it will provide another fillip for markets. And yes, the FTSE 100 is a notable underperformer, but if you can get a vaccine, then perhaps a lot of the sectors like housing that have struggled of late might start to recover. This index, of course, has lagged behind so badly, so many others, that it needs something that could really give it a lift. We've got Brexit, of course, hanging over us, but perhaps it's the kind of thing that will finally give us some more upside that perhaps allows the index to just play catch up with, particularly with the US, at least to some degree. So I think the vaccine still is the positive story that we're looking for and that we ultimately still need if we're to move on.
Okay, and Chris Vecchio, a vaccine in the new year, and then where are we in a year's time? Is everything rosy?
No, I'm unfortunately I can't give you a good response about this because when I was on paternity leave earlier this year, I got down into the virology hole, and I'm actually very pessimistic on having a permanent vaccine here. If something comes out, it's going to have to be administered at least once, multiple times a year. We already have 4 common strains of coronavirus: 229E, NL63, OC43, and HKU1. We've known about these forever. They're basically 30% of the common cold. When we say there's no cure to the common cold, we're talking about rhinoviruses and coronaviruses. Now, when SARS-CoV-1 and MARS-CoV broke out, scientists gave up on working on vaccines because by the time the outbreaks were contained, they were still so far away it was financially unfeasible. The Serum Institute in India says that in order to get the world at a place where we can reach herd immunity through vaccinations, it's not going to be until 2024. So I don't think that next year is going to be better. I think this is a rabbit that we're chasing that is giving us a carrot to look after to feel optimistic. I don't think that we're going to be getting a true vaccine anytime soon.
Okay. Chris, in London, I'm afraid your colleague's a bit downbeat there. Cheer me up. Give me some good news.
I think with the longer term, this is a very, very strong, I think for investors, very, very strong bull market. And I think we've weathered this storm quite well. And I think overall, I think that things will continue to move in the right direction. And people are very good at adapting. And I think Chris's point about there will need to be maybe continued doses of these vaccines administered people will learn to live with that kind of thing. And I think it doesn't necessarily undermine the idea that we continue to see market gains from here, which I think, given the outlook for the global economy, is still, I think, a very, very strong and positive outlook at this point in time.
Right. Well, that's you're right. Gents, that was really interesting. Really thankful for your time. It's Chris Beauchamp in London, Chris Vecchio in New York, both of IG. Thank you for joining us, gents, and perhaps we'll do it again.
Thanks. Cheers.
Thank you.